So what I want to do now is move on to start to do a bit of an exploration of these new iShares ETFs. So I was really, really excited. These came out about 2 weeks ago, and this is now the Advanced ESG Advanced series from BlackRock slash iShares Canada. So really, really excited about this. Kind of took a bit of a glance last time, but I've done a bit of a deeper dive. So happy to share with you sort of what I found. Really what's kind of cool is this product brief document that's down at the bottom, because this lays out sort of the family that they've created. I'll zoom in a little bit here, that they've created these 3 different ETFs, XCSR, which is the Canadian one, XUSR, which is the US one, and XDSR, which is EAFE, standing for Europe, Australia, and the Far East. So these really are like the core sort of geographic locations. Emerging markets is not part of this, so that is going to be a bit of a gap. It's really hard to do ESG investing in emerging markets. There are a couple ETFs, but they're not great. So I was hoping for a good one here. Unfortunately, it's not there, but it is what it is. I'll take it. You can see the management fees are very low on these. This makes me so happy that we have such low management fees. Keep in mind, this is the management fee, not the MER. The management expense ratio is going to be these numbers plus HST. Since they're domiciled in Toronto, I think all Canadian dollar ETFs that I've ever seen, that there's always the management fee and then the MER. And the MER is always going to be plus HST. So I can do like 0.15 times 1.13, and to get about, let's call it 0.17 for this one. And I'm going to go ahead and say about 0.22 and probably about 0.28 for these guys at the end of the day. You can see the number of holdings is, it is going to be on the lower side. This is the point. This is, we're purposefully not investing in the entire market. That really, we're trying to cut out certain things. So understandably, there aren't going to be as many holdings in some of the broader ones. But these are pretty good. Like, remember that, a lot of people invest in the TSX 60, which is like 60 companies, right? So, I wouldn't say that's a problem at all. And then obviously very, very new ETFs. They just came out a couple weeks ago. We can see the underlying index. So when I did want to dig through them, these are going to be the specific indexes that, if you want to look at that more strict methodology. But I think that this page does a really good job of kind of explaining the flowchart. So that's why I'm going to show you this. Let me just make this a little bit wider for now. So you can see that they're all going to follow a very similar methodology. This is the Canada, this is the USA, and the Europe, Australia, Far East. That for all of them, they need to have an ESG rating of greater than or equal to BBB rating. Now, I'm going to get in, there was a question about some of these ESG rating firms and MSCI versus Sustainalytics. Of course, this one is MSCI, so it's going to be theirs. These ratings aren't perfect, but they do a really good job. And in this case, the fact that it's going to be, BBB, we'll see. I'll show you some later on, and you can see that it usually is about half of companies are BBB or above in a given sector. Depends on the sector. Sometimes more of them are, but really this does tell me that we're going to get rid of roughly the lowest half of ESG scores. Certainly like the laggards, we're getting rid of them. From there is this controversy assessment. Now, I believe this is done on a scale of 1 to 5. So it does exclude companies with a controversy score of 0. So I think this is one of these where a lower score is better. I could be wrong. This looks weird to me. A very severe controversy. I'm not quite as clear on this. But it does look at those controversies. Might want to get a little more information there. I feel like this might be an error on their part. From there, in terms of the screens, it does exclude all companies, all businesses with an industry tied to fossil fuels, thermal coal, oil, gas, which means that it gets rid of pipelines, it gets rid of utilities, etc. But there is an exception provided to companies with over 50% revenue from renewable energy and alternative fuels. So there's a very specific company I'm going to address that is in the Canadian fund to kind of show you how this works. From there are other screens. You can see it excludes business with business involvement in adult entertainment, alcohol, civilian firearms, controversial weapons, conventional weapons, for-profit prisons, gambling, genetically modified organisms, nuclear power, nuclear weapons, palm oil, predatory lending, and tobacco. So this is like a pretty good list of the quote-unquote sin stocks. I gotta say, I'm impressed that they have for-profit prisons and predatory lending. That these are not things that I normally see when it comes to these funds. So this tells me that they've really been listening, and that, you know, when some of these issues do pop up, you know, the for-profit prisons, there was a whole thing about the CPP, Canadian Pension Plan, investing in this. Somebody heard that. That makes me happy. As well, the predatory lending, right? That makes me really happy. A lot of these payday lenders, things like that, won't be in there. Kind of cracks me up that it looks like the Canadian one does exclude cannabis. So they've got an explicit screen here. This has very much been in sort of the gray area. Should we exclude it or not? A lot of the older ones were created at a time when it wasn't legal. So there weren't cannabis companies. You can see here they go out of their way. Interesting to me that it's only the Canadian one, but I think that's because we're the only country still where it's legal. So it'll be interesting to see that if, you know, there is movement in the USA and they start having, you know, publicly traded cannabis companies, would this creep over? Probably, but we're not sure. From there, the last thing is the weighting. So it is interesting to me that the Canadian index does have a 10% issuer cap. So this means that no individual company is able to have more than 10% of the portfolio. This is going to prevent the big banks from like dominating. They might end up having a much higher weighting than we would want them to be. But for USA and EAFE, hasn't been a problem. They're just straight market cap weighted. What it does mean is that a couple companies, tech companies, are huge in this USA one. And that's really what I'm going to spend time showing you, is the sector breakdown, because there are some deviations there. So this is really the screening from a sort of a, you know, the methodology perspective. You know, it's kind of interesting here. They talk about ESG leaders. There is a little bit of a controversy score here. So, okay, so it looks like, yeah, it does. The controversy is on a 1 to 10 scale, with 0 meaning the most severe controversy and 10 meaning no notable controversy. So it looks like here, I was wrong here, that if it really has to be a very bad controversy to get out of the Canadian one, whereas in the American one and in the EAFE, you know, it's interesting there that there's a slightly different threshold. My guess is that they're really going out of their way, because Canada is so heavily focused on the energy sector, that if they had all of these other screens, they might have ended up with a much smaller number of companies. That would be my guess. Anyway, really cool document here. I like how they break it down. Gives me a lot of information. From there, let me just see this question here. Any concern about the size of the Canadian ETF, 2 million? Should an investor wait for it to get a little bit bigger before investing too much of their Canadian allocation in this ETF? So this is a great question, Dennis. I wish I had a better answer for you. It's one of these things where there is a little bit of a risk being one of the first through the gate here. So you can see here the net assets. What he's referring to is that there's, you know, about $2 million invested in this ETF, which isn't huge. To give you an idea, in order to break even, an ETF has to have about 100 million under management. Now, obviously, this is 2 weeks old, so it's going to take some time. In the US, what we saw is that when iShares came out with some of these new, stronger ETFs, there were foundations and pension funds like ready to jump in. So, you know, I'm curious to see whether there are some big investors in Canada who've been trying to divest from fossil fuels, who've kind of been struggling, that I think this approach might appeal to them. So I would like to see more money in this. Really what I would say is that I want to keep an eye on the volume. And I want to be clear that right now I'm not expecting very much volume at all for this. It's so new that if we look at it, let me just do the chart. You can see all those NAs. Really, I can do the 1 month chart and we have it here. You can see that basically on the 23rd, there was a fair bit of volume, about 5K. This is the volume here. So about 5,000 shares were purchased. Only 100 shares were sold the next day. No activity. From here, the volume, 1,700 shares were purchased, 200 shares were purchased, and 188 shares were sold. So, this is tiny volume. The way these ETFs work is that they do have something called a market maker. So what this means, and I don't know who it is for iShares, BlackRock might do it themselves. They're just so big. But the idea is that these are going to be sort of actors, financial institutions that kind of have a bit of a float, where they have shares and they will sell you your shares and they will buy your shares kind of no matter what. So, Dennis, really what I would say is it kind of depends how much money you're investing in this. If you're investing, let's say 10K or 20K inside this ETF, no problem. That's no worries. The market maker, they're going to handle this, no problem. If you're talking about investing $1 million right now in this ETF, you would then account for about a third of the shares. Obviously, you'd want to be very, very deliberate about that. I'm guessing we'd almost have to call up iShares and find out who the market maker is and kind of set that up in advance. So, this is my way of saying if you're going to put in larger amounts, I'd be very cautious. I would probably do it in chunks over time. And I would be really careful to use limit orders instead of market orders to ensure that you're not pushing it up. That said, if you're talking about investing less than 10K into something like this, I would say go for it. I don't really have any concerns. The bigger concern is that because it's so new, I don't have any data. Look at this, NA, across the board. When we look at the chart, there's just not, there are going to be days where it's it's going to be flat because there was no trading at all. So I would say I'm in no rush with this, that, you might want to give it at least a couple months. That said, if it's a smaller amount of money in relation to that, 2.2 million, by all means, I would say go for it, but just be careful about it. Hopefully that's helpful. So when we look at it, really the thing that stuck out to me as I was looking through it is the sector breakdown. And so this is the Canadian one, and you can see here so much in financials. Now, obviously no energy in here, but it was a little bit interesting. And then as well, if I can get maybe next to it, why don't I do it over here, XUSR, here it is, and let me bring this over. That when we look at the sector breakdown for the US one, it's huge when it comes to tech. That really, this is going to be my concern, is the sector breakdown. So being the math nerd that I did, I created a little Excel spreadsheet today. Let me make it a little bit bigger for you. Hopefully you can read this. Let me know if there's any issue. I'm a little bit worried about my face cutting it off, so maybe I'll make the window kind of like this. Okay, so basically Canada, USA, EAFE. Down here, what I have is my benchmark, the MSCI All Country World Index. So this is the standard global equity ETF. And what I did is I kind of, I did mine. I don't really know where I got these numbers from. I kind of did it sort of according to a couch potato or again, the standard breakdown. But I did 15% for Canada, which is a bit of a home bias. We've talked about this in the past. You wouldn't have to go this high if you didn't want to. But I think a lot of Canadians would do about 15%. Half of it for the US, and then 35% of it for Europe, Australia, the Far East. So we can play with these numbers. If you want me to do it in a different way, then I'm happy to take those, just throw it in the little chat, and I'm happy to do the numbers in real time. What you can see here is that by doing it at this combination, we're going to have about 27% exposure to the tech sector, which is quite a bit higher than the 19% that it is in the All Country World Index. Now, tech has done phenomenally well as a sector. So if there's a sector that I'm kind of okay being overweight, it might be tech, But at the same time, like, again, tech has done really well. Is it really worth those valuations? And it does tend to be a little bit more volatile, although in the current pandemic situation, tech has been some of the better because obviously everyone's going online like we're doing right now. So, it's one of those things that's a little bit tricky. It is what it is, but very, very high when it comes to tech. When it comes to financials, a little bit over, not too much. Obviously, if we put a heavier weight into Canada, this number would start to skew, right? So that's why I would say be aware there. But we're not out to lunch in terms of financials, as long as it's a nice diversified portfolio. Healthcare, we're very, very underweight healthcare, which again, some people will be okay with this. There's going to be a lot of big pharma. That said, especially right now, I think people understand why healthcare stocks are kind of an important part of the portfolio. And again, it is what it is, but very low exposure there, or lower than average. In terms of industrials, we do get a little bit more. In terms of consumer discretionary, we get a little bit less. Consumer staples, we're pretty close. Communication services, we're under a little bit, right? And then utilities, this is another one where, again, we're quite a bit under, less than 1%. Versus 3.35% in the benchmark. So again, we can always round this out. We can always get a little more exposure to some of these sectors if we want to. I know a lot of my clients really love those renewable energy utilities. They've done quite well for us over the last few years. So, might not be a bad idea if you do want to own some of those, hold those as individual stocks just to bump up your allocation there a little bit. We're a little bit heavy when it comes to real estate, and then a little bit heavy when it comes to materials. So, really utilities to me is the flag. Healthcare to me is the flag right there. And technology, the fact that we're really, really overweight tech. So, I'm going to play with some different ideas of, ETFs that we might be able to use to round this one out. I'm a little bit cautious. Normally, the doing more good one that is sort of my go-to one is PZD, the Invesco Clean Tech ETF. But that one has a lot of exposure to industrials, which we're already heavy on, and tech, which we're already heavy on. So again, to me, I don't know if that's going to be the best sort of complement, doing more good sort of complement to this sort of suite of iShares ETFs. It'll be really, really interesting to see how they perform. I just love it when there are more options on the market, just because more competition is good, so the fees come down. I feel like this is going to get, 90% of the way there for most of my clients when it comes to the doing less evil perspective. Obviously, it'll be up to you. There might be some companies in here that you're like, Tim, how did that get in? Why are they in here? But if we look at the US one, look at how high Microsoft and Apple are, and even Google, which is in here twice, so you sort of have to add these up. They have voting shares and non-voting shares, which is why they're in here twice. And then from there, it does, the percentages do go down considerably. You can see that it is nice and diversified after those major tech companies. It's curious to me, no Amazon, no surprise there, probably on the ESG side or the controversy side. But as I scroll through it, really no sort of major red flags for me as I did go through these ETFs. In terms of the fossil fuel free aspect, so they are fossil fuel free, but remember there was that little caveat where if it's more than 50% in renewable energy. So I have a client, I believe it's Michael, who is just amazing, who's come up with this incredible database that he sent me. And what he did is he used a database to be able to flag all of the different fossil fuel companies that are in here. And so we'll start with Canada. You can see it's a very small allocation, but there would be a little bit of natural gas. What it comes down to is really this company, Northland Power. I just wrote about them for Corporate Knights and the Toronto Star, so that article will come out on Monday. But they do have, I think it was roughly about 32%. I want to double check my math there, but about, I'll say over 30% from natural gas. So that's why they get flagged here as a fossil-fired utility. No coal in here at all, but they do have a little bit of natural gas, which is why they get flagged. In terms of the EAFE, there are a couple of small companies in here. Again, probably would want to dig into these guys. Horizon, I just don't know very much about them. Let's see if I can do a quick search. Horizon Mines probably is going to be the company. Let me see here. Hold on. It's holdings, so let me just do holdings. And again, so this would be a freight rail operator. Fascinating. So because they move coal, this is like a train company that moves coal. So that's why they would get flagged in there. Isn't that interesting? And then on the US side, there's really only the one company, Consolidated Edison. Again, this would be a utility. But really, these numbers are so small that, I'm pretty encouraged by this. So pretty happy, I'm excited. I would say let's give it time. I'm in no rush to make any changes, do things, anything major, but, really love that these guys exist. Let me see here in terms of the question.